Hello and welcome to our quarterly market update for October 2021. I am Michael Ball, Managing Director of Weatherstone Capital Management. In terms of things that we're going to cover this quarter, we'll look at the standard charts that we've been looking at the last couple of quarters in terms of COVID updates, looking at kind of where that stands. Also, we'll take an update on the economic recovery here in the U.S. and how that continues to progress along. And then we're going to take a deeper dive looking at inflation pressures and how it looks like that could be higher for a longer period of time than what was initially expected by the Federal Reserve, and some of the challenges that that can bring, particularly to bond investments. We'll wrap up then by going over current positioning in our fixed income models, as well as the equity models and current changes and things that we have made there. As we look at the impact of COVID, obviously the Delta variant has had a significant impact both here in the US and worldwide, as we've seen a big uptick in cases. And fortunately, as the chart here shows, we're starting to see those numbers roll over and get better. And so if we look at the 7-day average of cases from its peak level, that's come down by 48%, which is very encouraging. Fatalities, which will lag always a little bit, are also down 28% from their peaks from a few weeks ago. So while it's been discouraging to have the Delta variant come and slow down things with COVID, it does seem to be getting settled down and behind us. And as we see on the chart on the right-hand side, that when we look at the headway that's being made with continuing vaccination, as well as those people who have had infections and build up natural antibodies, we're up and now over 80% that have some immunity resistance to the disease, which should help us going forward. As we look at how the vaccine rollout is going on a global basis, we can see in the chart here that the U.S. has actually started to drop behind many of the major world countries in terms of number of doses per 100 people. But it does show that on a global scale that vaccinations are up significantly, which should help to slow the spread of COVID. Obviously, emerging markets are lagging behind somewhat, but there's significant improvement coming along there as well, which should be hopeful for future quarters. Despite the uptick in the Delta variant of COVID, we're still seeing the economy recover quite nicely from the drop-off that we saw last year, and quickly returning back to its long-term trend line growth. Obviously, much of what we've seen in the past year has been heavily impacted by the government stimulus packages, and as that starts to slow down, we need the organic growth of the economy to pick up and take over the slack. But so far, that continues to look quite promising. One piece of data showing the growth potential for the U.S. economy is the continued record number of job openings across many segments of the economy. As more workers come back into the economy and if supply chains are able to get back to normal, it should continue to provide good momentum for the economy to grow throughout the remainder of this year and into 2022. Turning to our focus topic this quarter, one of the key things that we want to keep an eye on over the next few months is whether the inflation that we're seeing is transitory or not. Some of the key officials at the Federal Reserve Bank have said that while inflation is above their primary target of 2%, that they don't expect this to be a longer-term problem, and that the inflation pressures are temporary or transitory, in their words. As a result, we've seen the inflation concerns that pushed up interest rates last year and early part of this year begin to reassert themselves once again, as the inflation levels seem to be staying up higher longer than initially expected earlier this year. Turning to some of the recent statements and actions from the Federal Reserve Board, they initially said that the jump above 2% was in their view going to be temporary, but they're acknowledging now that inflation is staying higher for a longer period of time, and in their words is frustrating, and that the supply chain problems are one of the primary factors to that, as long as with the tight labor markets. Inflation projections are being revised higher, but consumer expectation and longer term items such as housing and labor costs may necessitate further adjustments upward for inflation expectations, and that may start to have an impact on bond prices further than what we've seen so far. As noted in the items listed on this slide, areas such as owner's equivalent rent, which makes up 1/4 of the consumer price index, is currently only up 2.6% over the past year. But this number typically takes a bit longer to flow through, and obviously with housing prices up and rent prices up, it's likely to move higher over the next year. And as noted, it's about 25% of the consumer price index. Likewise, significant increases in the price of land, construction materials, and other building materials are likely to be elevated for quite some time, as are labor costs. These are all rising at an above average pace. Finally, consumer inflation expectations are moving higher more quickly than that of Federal Reserve bankers, and this is beginning to have a higher impact on bond markets. We've been at near zero interest rates since COVID hit the economy. And in addition, the Federal Reserve has been buying $120 billion per month in bonds to help keep interest rates down and to pump additional money into the economy. If the Federal Reserve needed to hike interest rates to slow down the impact of inflation, it would need to first discontinue its bond buying program, which is expected to take nearly a year to wrap up, and which would keep the Fed from hiking interest rates to be able to quickly contain inflation if it starts to become a bigger problem. One important impact of increasing inflation and the Federal Reserve stating that the uptick in inflation is only temporary is that bond interest rates have not moved up much yet, and when viewed on an after inflation basis are at some of the most negative levels that we've seen since the 1970s. This is a real challenge for fixed income investors because it's becoming increasingly difficult to earn a return that can keep you ahead of inflation in bonds. This is particularly true for investors in risk-free government bonds. Fortunately, we're still finding areas in the bond market where we can make respectable return on bond investments, but typically we're finding those in areas that are economically sensitive, so we do need to be aware of and manage risks that may arise if we were to experience another recession. On this chart, on the left-hand side, it highlights the significant differences in returns between segments of the bond market that are economically sensitive versus those that are not. On the right-hand portion of the chart, it also shows the expected magnitude of impact that interest rates going up by 1% will have on various areas of the bond market. So we can see, for example, that areas that have obviously longer maturities are more heavily impacted, and that areas that are typically less economically sensitive or are floating rate have very modest, if any, impact in that type of an environment. The last chart that we'll look at in discussing this topic will focus on where interest rates are, where they have been, and kind of the range that we have seen over the past 10 years. The current line, or in the middle, kind of the blue that gives the end of quarter, shows the current yield curve, essentially what are the interest rates over various maturity dates. The purple line at the bottom, which is the bottom of that gray area, and the lowest levels that we had been in the past 10 years, was virtually just 1 year ago, as we were still in the middle of the pandemic. The gray level goes to the highest level that we have been in the past 10 years, and we see, for example, where it was as of the end of 2013 after the Fed wrapped up one of their earlier bond buying programs as we were coming out of the great financial crisis. So this can give you example of areas over which interest rates could reasonably expect it to fluctuate depending on how strong or weak inflation turns out to be over the next year. We've obviously moved quite a bit closer to the middle of that range with the initial uptick that we have seen in inflation. If we do see it continue to be stronger, to move towards the upper end of that range would be pretty normal in order to turn the after inflation return on bonds hopefully back to a positive number for investors. When we look at how our tactical fixed income portfolios are currently positioned, we lean very heavily towards economically sensitive areas of the economy. Also, we've incorporated in floating rate bank loans, and we've minimized during the past quarter municipal bonds that tended to have longer term maturities. This has helped us to find good stability and to be able to make gains where many other areas of the bond market have struggled. It looks like, based upon the current economic strength, that we should be able to stay with the same positions here for at least the next few months, if not next few quarters. When we look at our equity market positioning, during the past quarter, we made some adjustments to minimize risk by raising cash, as our shorter term risk measurement models tended to fluctuate between low positive readings and slightly negative readings during August or September. As we moved into October, our risk measurement models moved back to being a bit more positive, so we have returned to a fully invested position for stocks. The risk measurement model for international stocks also turned positive, but does not look quite as strong, so we have not been allocating any to that area at this time. So while the short-term risk measurement models are looking positive, longer term, we're still quite cognizant that higher valuation levels point to above average risks if stocks start to experience some negative headwinds that start to last for an extended period of time. Finally, as we look at our favored sectors of the market, we've had positions in energy and commodities for a while. In some cases, we have increased those somewhat, and with oil prices and other commodity prices moving higher, that's worked out quite well for us during the choppiness that we have seen over the past few months. Also, we're getting high positive readings from our various models on financials, some areas of technology and telecommunications, generally areas which tend to be a bit less economically sensitive there. So as we wrap things up for another quarter, once again, COVID has thrown us a little bit of a curveball and has been a problem for the full economic reopening. But with the Delta variant now beginning to roll over in many areas of the world, hopefully we'll get the reopening back on track and get back there fully in the coming quarters. The bigger issue as we look at it in terms of impact to investments is whether inflation is going to be transitory or if it's going to be longer term and more sticky, as the Federal Reserve is starting to hint that it's becoming more concerned about. This longer period of above average inflation is something that we've really not experienced since the 1970s or into the early 1980s. If it does prove to be more than just a temporary bump, then it could have a significant impact on bond markets, which would need to readjust to higher inflation for an extended period of time and possibly spill over to stocks. Our bond allocations, even with the headwinds of higher inflation, are primarily in economically sensitive areas of the bond market, and that's helped us to generate above average returns in our fixed income portfolios throughout this year. With that, we'll wrap it up and wish you a happy holiday season upcoming, and look forward to talking to you after the first of the next year. Thank you.